Welcome to The Explainer, where we turn complex documents into clear, actionable insights. Today, we're jumping right into a super critical and, let's be honest, often tricky part of the tax audit report, Clause 19. You know, every business owner understands that a tax audit is serious stuff. But what if I told you that some of the absolute best deductions you can get, the ones that are designed to save you the most money, are also the ones hiding the biggest risks? That's really the question we're digging into today. Are your deductions a smart financial play, or are they a ticking time bomb just waiting to go off? So here's our game plan. We'll kick things off with what I call the deduction minefield. Then we're going to decode Clause 19 itself. After that, we'll get into its crazy domino effect, look at the most common pitfalls, and then wrap up with a really practical audit survival guide. Let's get into it. Okay, so first up, let's get a lay of the land. The whole point of a tax audit report, at its heart, is transparency. And you can bet that no other part of that report gets a closer look from the tax authorities than Clause 19. Why? Because that's where some of the most powerful, and therefore riskiest, deductions live.
Yeah, think of it this way. The government offers these awesome deductions to encourage certain things, right? Stuff like scientific research or investing in key industries. But with these big benefits comes big responsibility. Getting these claims exactly right is absolutely crucial because the tax authorities are definitely scrutinizing them. And getting them wrong, well, that comes with some very costly consequences.
All right, let's pull back the curtain a bit and really decode what's inside this minefield. When we talk about Clause 19, what deductions are we actually talking about? In plain English, this is the one specific spot in the audit report where your chartered accountant officially lists out all those big, high-value, special deductions your business is trying to claim. And let me be clear, these are not your normal, everyday business expenses. Nope. These are the deductions that come with a whole laundry list of rules and conditions that have to be met perfectly. And just look at the sheer variety we have here. This is not a one-size-fits-all kind of thing. We're talking about everything from putting money into a T development account, all the way to massive capital spending on new hospitals or hotels. It even covers huge intangible things like telecom spectrum. And the key thing to remember here is that every single one of these has its own maze of complex rules.
Okay, now here's where things get really, really practical. A mistake in a Clause 19 claim, it doesn't just stay in Clause 19. It actually triggers a chain reaction, like a domino effect, that can knock over other parts of your tax report and lead to even bigger problems.
Let me walk you through a classic example. Let's say you build a new warehouse and you claim 100% deduction for it under Section 35 AD. A huge tax saving. But, and here's the kicker, you miss one tiny condition. Suddenly, that deduction is invalid. And that entire expense gets reclassified, and your auditor then has to report it as a disallowed expenditure in a totally different section, Clause 21A. You see? The first domino falls, and it immediately knocks another one over. And here's another perfect example of this chain reaction. Imagine your company buys telecom spectrum rights this year. You correctly report it in Clause 19, but there's a catch, and it's hidden in another part of the tax law. The deduction is only allowed when you actually pay for it, when the cash leaves the bank. So if that payment hasn't been made yet, your claim in Clause 19 is basically worthless. So now that we see how these mistakes can cascade, let's zero in on the most common traps that businesses fall into. Because really, knowing where the mines are is the best way to make sure you don't step on one. This one is a classic, the paperwork trap. For some scientific research deductions, for instance, you need a whole separate, specific audit report from an accountant just to verify that spending. Your main tax auditor is allowed to rely on that report, but if you fail to get it, well, now your auditor's hands are tied. They have no way to verify the claim. The deduction is just unsubstantiated and becomes a huge red flag. We just touched on this, but it is so important it really deserves its own spotlight, the timing trap. This distinction between when you incur a liability, when you owe the money, versus when you make the actual payment is a critical detail. For big-ticket items like telecom licenses, that deduction clock only starts ticking when the money actually leaves your bank account, not when you sign on the dotted line. And just listen to how stark this is. This is straight from the official guidance, and it is
totally unforgiving. Notice the wording here. It doesn't say the deduction may be disallowed. It says it shall be deemed wrongly allowed. That language is absolute. There is zero wiggle room. You miss one condition and the whole thing can just be wiped out.
For years, this number is incredibly important. It means this risk doesn't just disappear after you file your return. The tax authorities have 4 full years to come back, reopen your case, and reverse that deduction. A mistake you make today could pop up 3 or 4 years from now as a sudden, unexpected demand for back taxes, plus interest, and yes, penalties. It's a ghost from the past that can seriously mess with your future cash flow.
So, how do you navigate this minefield without stepping on a mine? It's not about avoiding these powerful deductions, it's about claiming them the right way. So here is a simple survival guide to help you do just that. This checklist isn't just a list of tasks, it's about a fundamental shift in your mindset, from being reactive to being proactive. It's about treating these deductions with the serious respect they demand before you claim them. This means creating a whole dossier for each claim, verifying every single condition, getting the right paperwork, confirming payment dates. And your chartered accountant? Think of them not just as someone who signs off at the end, but as your strategic partner in navigating this whole thing from the very beginning.
So, Clause 19 really presents a choice. It can be a source of incredible value, or it can be a source of significant risk. Now that you have a map of the terrain, the question isn't just whether you're audit ready, it's whether you've built the discipline and the foresight to turn these potential mines into actual milestones for your business's growth.